I've been managing money through volatile markets for almost 50 years now, and I've watched brilliant people, people with Harvard MBAs, people with decades of experience, make the same mistakes over and over again during volatility. And these mistakes, they don't just cost them returns, they destroy generational wealth. I'm talking about portfolios cut in half, retirement plans devastated, life savings gone. And here's what kills me. These mistakes are completely avoidable, every single one of them. At BlackRock, we manage over $11 trillion through volatile markets, and I can tell you exactly what separates the investors who build wealth during volatility from the ones who get destroyed. That's what I want to share with you today. 5 specific mistakes that will kill your portfolio in volatile markets and exactly how to avoid every single one of them. Now, before we dive in, let me be clear about something. Volatility is not the enemy. I know it feels terrible when markets swing 3%, 5%, sometimes 10% in a single day. Your stomach drops. Your portfolio shows massive red numbers. The news is screaming catastrophe. But volatility itself doesn't destroy wealth. What destroys wealth is how you respond to volatility. The mistakes you make when fear is high, the emotional decisions you make when panic sets in. And I've seen these mistakes repeated over and over again. 1987, 2000, 2008, 2020, and right now in 2025. Different crises, same mistakes. At BlackRock, we've studied this extensively. We've analyzed millions of investor accounts. We've tracked what successful investors do differently from unsuccessful ones during volatile periods. And the data is overwhelming. The difference isn't intelligence. It's not access to information. It's avoiding these 5 critical mistakes. So let's dive in. Mistake number 1. And this is the biggest wealth destroyer I've ever seen. Trading too frequently during volatility, trying to time every swing, jumping in and out, chasing moves. And I see this constantly. Markets fall 5%, people sell. Markets bounce 3%, people buy back in. Markets fall again, they sell again. And every single one of those trades costs them transaction costs, spreads, taxes. But more importantly, they're almost always buying high and selling low. They're doing the exact opposite of what they should be doing. Let me give you some numbers that will shock you. There's a study that looked at retail investor accounts over a 20-year period. The investors who traded most frequently, who were constantly moving in and out, they underperformed buy and hold investors by an average of 6.5% per year. 6.5%, that's not a typo. Over 20 years, that difference is catastrophic. A $100,000 portfolio that compounds at 10% annually becomes $672,000. But that same portfolio compounding at just 3.5% after trading costs and bad timing becomes only $199,000. Nearly $500,000 just from trading too much during volatility. And here's what's insidious about this mistake. It feels like you're doing something. It feels active. It feels smart. You're watching the market, you're reacting, you're making moves, but you're actually destroying your wealth. Every trade you make during volatility is probably the wrong trade. Now, why do people make this mistake? 2 reasons. First, loss aversion. When you see your portfolio falling, you feel pain, real psychological pain, and you want to stop that pain. So you sell, you go to cash. The pain stops temporarily, but then you've locked in your losses. You've made them permanent. Second, action bias. Humans have this deep need to do something during uncertainty. Sitting still feels wrong, feels passive, feels like you're not in control. So you trade, you act, you make moves, even though the best move is usually no move at all. Just holding. At BlackRock, we've built our entire investment philosophy around low turnover. Our most successful strategies, the ones that have compounded wealth for decades, they trade very little. Some of our funds have turnover rates below 10% per year. That means we're holding positions for 10 years on average. Compare that to the average retail investor who turns over their entire portfolio every year or even multiple times per year during volatility, and the results speak for themselves. Low turnover strategies outperform high turnover strategies over every meaningful time period, every single one. So here's how you avoid this mistake. First, commit to a minimum holding period. Write this down. I will not sell any position unless I've held it for at least 1 year or unless the fundamental thesis has been completely invalidated. Not because the price fell, not because volatility increased. Second, track your trading activity. Most people have no idea how much they trade. Keep a log, write down every trade, why you made it, how you felt. Then 6 months later, go back and review. You'll see the pattern. You'll see that most of your trades during volatility were mistakes. Third, implement what I call a trading friction system. Make it harder to trade impulsively. Don't keep your brokerage app on your phone. Don't check your portfolio multiple times per day. Set up a rule that any non-emergency trade has to wait 72 hours. Sleep on it, think about it. Usually you'll decide not to do it. Fourth, calculate the true cost of trading. Every time you want to make a trade during volatility, calculate what it's really costing you. The spread, the commission, the potential tax hit if it's a taxable account. Then ask yourself, am I really getting enough value from this trade to justify these costs? And finally, remember this. The best investors in the world, Warren Buffett, Charlie Munger, the great institutional investors, they trade very little. They find quality, they buy it, and they hold it through volatility. They let compounding do its work. That's how wealth is built, not through constant trading. All right, mistake number 2, and this one is subtle but devastating. Abandoning your asset allocation during volatility. Here's what happens. You've set up a portfolio. Let's say 60% stocks, 40% bonds. That's your target. That's your strategic allocation based on your risk tolerance and time horizon. Then volatility hits. Stocks fall 20%. Now you're sitting at maybe 52% stocks, 48% bonds, and instead of rebalancing back to your 60-40 target, instead of buying stocks when they're down, you do the opposite. You get scared, you sell more stocks, you go to 40-60 or even 30-70. You've completely abandoned your strategic allocation. You've let emotion override your plan. And here's the problem. Your asset allocation is the most important decision you make as an investor. It drives 90% of your returns over time, more important than which stocks you pick, more important than timing. And when you abandon it during volatility, when you shift dramatically towards safety, you lock in your losses and miss the recovery. Let me give you a specific example from 2020. The pandemic hits in March. Markets fall 34% in 5 weeks. Absolute panic. And I watched investors slash their equity allocations. People who were at 60% stocks went to 30% stocks. They moved everything to cash and bonds. They felt safe. They stopped the pain. But what happened? By August, just 5 months later, markets had fully recovered, and those investors who abandoned their allocations missed the entire bounce. They were still sitting in cash. Meanwhile, disciplined investors who maintained their 60-40 allocation, who actually rebalanced and bought more stocks when they were down 34%, they captured the full recovery. They came out ahead. That's the power of maintaining your strategic allocation through volatility. You force yourself to buy low and sell high. Now, I know what you're thinking. Larry, it's easy to say maintain your allocation, but when you're watching your portfolio fall 20%, 30%, maintaining discipline is almost impossible. And you're right, it is hard. That's why you need a system. That's why you need rules that override emotion. Here's the system we use at BlackRock and that I recommend for individual investors. Set rebalancing bands. Write down your target allocation. 60% stocks, 40% bonds, whatever it is for you. Then set bands around that target, maybe plus or minus 5%. So if you're 60-40, your bands are 55 to 65% for stocks. When your allocation drifts outside those bands because of market movements, you rebalance back to target, mechanically. No emotion, no debate. The rule is clear. You've drifted outside your bands, you rebalance. And here's what's powerful about this. Rebalancing forces you to buy what's down and sell what's up. During volatility, when stocks have fallen and bonds have stayed stable, rebalancing means selling bonds and buying stocks. You're buying the dip, but you're doing it systematically, not emotionally. You're not trying to time the bottom. You're just maintaining your strategic allocation. And over time, this adds tremendous value. Research shows that disciplined rebalancing can add 50 to 100 basis points of annual return over not rebalancing. That's 0.5% to 1% per year. Doesn't sound like much, but over 30 years that compounds into hundreds of thousands of dollars of additional wealth, all from just maintaining discipline. But over 30 years, that compounds into hundreds of thousands of dollars of additional wealth, all from just maintaining discipline. Second component of avoiding this mistake: document your allocation strategy in writing. Create what's called an investment policy statement. It sounds formal, but it's just a simple document that says, this is my target allocation, this is why I chose it, this is when I rebalance, this is what I don't change. And when volatility hits, when you're tempted to abandon your allocation, you go back to that document, you ask yourself, has anything fundamental changed about my situation? Am I retiring next year instead of 20 years from now? Has my risk tolerance genuinely changed? If the answer is no, you stick to the plan. Third, understand that your allocation should only change for life reasons, not market reasons. You change it because you're getting older. You change it because your income situation changed. You change it because you're approaching retirement. You don't change it because markets are volatile. Volatility is not a life change. And finally, if you really can't handle the volatility of your current allocation, if 60-40 is genuinely too much risk for your psychology, then change your strategic allocation. Go to 50-50 or 40-60, but do it deliberately. Do it when markets are calm. Write down your new allocation and commit to it. Then stick to it through the next volatility. All right, mistake number 3. And this is the one that keeps me up at night because I see it destroying portfolios constantly. Reaching for yield in the wrong places during volatility. Let me explain what I mean. When markets are volatile, when stocks are falling, investors get scared of equities. They want safety, but they also want income. They don't want to just sit in cash earning nothing. So they start reaching, they buy high-yield bonds, junk bonds from weak companies. They buy preferred stocks. They buy REITs that are over-leveraged. They buy dividend stocks from struggling companies. They're chasing yield, and they think they're being conservative because these investments pay income. They feel safer than stocks. But here's the brutal truth. During real volatility, during actual market stress, these high-yield investments fall just as much as stocks, sometimes more. They don't provide safety. Let me give you specific numbers from 2008. High-yield bonds, junk bonds, they fell 26% that year. Investment-grade corporate bonds fell only 5%. Treasury bonds actually went up 14%. So if you were reaching for yield in junk bonds thinking you were safer than stocks, you got crushed. You lost the downside protection. Same thing happened in 2020. When the pandemic hit, high-yield spreads blew out. Junk bonds fell 13% in March alone. Meanwhile, high-quality government bonds and investment-grade corporates held their value or even appreciated. The high-yield strategy failed exactly when you needed safety most. That's the pattern. And here's why this happens. High-yield investments pay high yields for a reason, because they're risky. The companies issuing them are weak. Their balance sheets are stretched. Their cash flows are uncertain. When economic conditions deteriorate, when volatility increases, these companies struggle. Default risk spikes. And when default risk spikes, high-yield bonds act like stocks. They fall. They become correlated. You don't get diversification. You don't get safety. You just get high risk with slightly more income. That's not a good trade during volatility. At BlackRock, we're very careful about credit quality during uncertain times. We move up in quality. We want investment-grade corporates, not junk. We want government bonds, not speculative credits. Yes, the yields are lower, but we're getting actual diversification, actual safety. When stocks fall, these high-quality bonds hold steady or appreciate. That's what you need in a portfolio. Now, I know what you're thinking. Larry, yields on high-quality bonds are so low. I can't live on 3% or 4%. I need more income. I understand that concern. But here's what you have to understand. During volatility, preservation of capital is more important than generating income. You can't spend money you've lost. If you chase a 7% yield in junk bonds and lose 25% of your principal during volatility, you're not winning, you're losing badly. You'd be much better off with a 3% yield on treasuries that maintains its value, lower income, but your capital is intact. And when the recovery comes, you can redeploy into higher returns. So here's how to avoid this mistake. First, during periods of elevated volatility, move up in credit quality. If you're in high-yield bonds, shift to investment grade. If you're in lower-rated investment grade, shift to higher-rated. If you're in corporate bonds, consider adding more government bonds. Second, focus on total return, not just yield. Too many investors obsess about the income their portfolio generates and ignore capital appreciation or depreciation. But total return is what matters. A bond yielding 3% that appreciates 5% gives you 8% total return, better than a bond yielding 7% that falls 10%. Third, use the core satellite approach for income. Keep the core of your portfolio, maybe 80%, in high-quality diversified assets, stocks, investment-grade bonds, government bonds. Then if you want to reach for yield, do it with 10% or 20% in a satellite allocation. REITs, high-yield dividend stocks. That way, if the reach for yield goes wrong, if those high-yield assets fall during volatility, it's only affecting a small part of your portfolio. Your core is protected, you have downside protection, but you're still getting some extra income from that satellite allocation. That's risk management. That's smart portfolio construction. Fourth, remember that cash is okay during volatility. I know earning nothing feels terrible, especially in an inflationary environment, but cash serves a purpose. It's optionality. It's dry powder. When volatility creates opportunities, when quality assets go on sale, you want cash to deploy. That's worth more than chasing yield. And finally, if you genuinely need more income than your portfolio can safely generate, you have two options. Either increase your risk tolerance and accept more volatility in exchange for higher potential returns, or reduce your spending. Those are the only two solutions. Reaching for yield in the wrong places isn't a solution. It's a disaster. All right, mistake number 4. And this one is particularly painful because I see it happen to smart, experienced investors. Abandoning diversification and going all in on one theme during volatility. Let me explain what this looks like. Markets become volatile. A particular narrative emerges. Maybe it's inflation is coming, so investors sell everything and buy only gold and commodities and inflation hedges. Or the narrative is tech is the future, so they sell everything and buy only tech stocks. Or it's recession is coming, so they sell everything and go 100% into defensive sectors. They abandon diversification completely. They concentrate. And here's the problem. Narratives during volatility are almost always wrong, or at least incomplete. They're too simplistic. They don't capture the complexity of what's actually happening. And when you bet everything on one narrative, one theme, you're taking massive concentration risk. If that narrative is wrong, you're devastated. Let me give you an example. In 2021 and 2022, the narrative was inflation is coming back. Persistent structural inflation. So a lot of investors loaded up on commodities, on energy stocks, on inflation-protected securities. And yes, inflation did spike. Those investments did well for a while. But then inflation started coming down. And in 2023, those same investments struggled. Energy stocks fell. Commodities fell. Meanwhile, the tech stocks that everyone had abandoned, they rallied 40%, 50%, some more. The investors who had gone all in on the inflation theme missed the entire tech rally. They were positioned for yesterday's narrative, not tomorrow's reality. Or think about 2008 and 2009. During the financial crisis, the narrative was the financial system is collapsing, banks are going to zero. So some investors sold all their financial stocks, and yes, many banks did collapse. But the ones that survived, JP Morgan, Wells Fargo, Goldman Sachs, they recovered massively. If you had abandoned financials completely, if you'd gone all in on defensive sectors, you missed multi-bagger returns from quality financial companies that were thrown out with the trash. That's the danger of narrative investing. You think you're being smart following the obvious theme, but you're actually taking concentration risk. Now at BlackRock, we think about narratives and themes constantly. We analyze macro trends, we position for structural changes, but we never abandon diversification, never. We might overweight a theme, we might allocate 25% or 30% of a portfolio to a high conviction idea, but the core remains diversified. Why? Because we know we're going to be wrong sometimes. Everyone is. The best investors in the world are wrong 40% of the time, so if you concentrate everything on one theme, one narrative, and you're wrong, you've blown up, you can't recover. But if you maintain diversification, being wrong about one theme doesn't destroy you. So here's how to avoid this mistake. First, commit to maintaining diversification across asset classes. Even during volatility, even when one narrative seems obvious, keep some stocks, some bonds, some alternatives, some international exposure. The exact allocation can shift based on your analysis, but maintain the structure. Second, use position limits. At BlackRock, we have strict limits on how much of any single security, sector, or theme we can hold in a portfolio. For individual investors, I recommend no single theme should exceed 25% of your portfolio, even if you're absolutely convinced. Even if it seems like the most obvious trade in the world. That 25% limit forces diversification. It forces you to maintain other positions, other themes, other exposures. And when your high conviction theme is wrong, which it will be sometimes, you're protected. The other 75% of your portfolio keeps working. You survive to fight another day. That's how you compound wealth over decades. Third, separate your portfolio into core and explore. The core, maybe 70 to 80%, stays diversified always. Broad market exposure, multiple asset classes, global diversification. Then you have your explore allocation, 20 to 30%, where you can make thematic bets. But the core never gets abandoned. Never. Fourth, test your narrative. If you think inflation is coming and you want a position for it, don't just go all in. Ask yourself, what would have to happen for me to be wrong? What would invalidate this thesis? Write down the conditions, then monitor. If those conditions start appearing, you adjust. You don't double down. And finally, remember that volatility creates multiple opportunities simultaneously. Yes, maybe inflation is a risk, but also recession is a risk. And maybe tech innovation is accelerating despite volatility. And maybe international markets are cheaper than US markets. All of these can be true at once. Diversification lets you benefit from all of them. All right, final mistake. Mistake number 5. And this is the most fundamental, most important mistake to avoid. Ignoring your time horizon and investing like you need the money tomorrow when you actually don't need it for decades. Let me explain what I mean. When volatility hits, when markets are falling, every instinct tells you to protect, to get defensive, to move to safety. And if you actually need the money soon, if you're retiring next year or you need cash for a down payment in 6 months, that instinct is correct. You should be defensive. But most investors don't need the money soon. They're investing for 10, 20, 30 years from now. Yet they react to volatility as if they need the money tomorrow. They sell stocks because markets fell 20%. But they weren't going to touch that money for 20 years anyway. The market falling 20% today is completely irrelevant to their 20-year goal. In fact, it's an opportunity, but they don't see it that way. They see short-term pain and they react. And this is the ultimate wealth destroyer because it turns temporary volatility into permanent losses. Let me give you numbers. If you're 35 years old investing for retirement at 65, you have 30 years. If markets fall 30% today, that's noise. Literally noise over a 30-year period. Markets have always recovered from 30% falls. Always. But if you sell during that 30% fall, if you lock in your losses, if you miss the recovery, you've just destroyed decades of potential compounding. Let me show you what I mean. $100,000 invested at 35 years old, compounding at 10% annually for 30 years becomes $1.74 million. That's the power of time and compounding. But if you panic sell during one 30% decline, miss the recovery, and your average return drops to just 7% because of that mistake, that same $100,000 becomes only $761,000. You've given up almost $1 million. $1 million lost because you reacted to short-term volatility despite having a 30-year time horizon. This is the mistake I see most often, and it breaks my heart because it's so unnecessary. At BlackRock, when we manage pension funds, endowments, sovereign wealth funds, these are institutions with infinite time horizons. They're never going to liquidate. And you know how they behave during volatility. They buy more. When stocks fall 20%, 30%, they rebalance. They deploy capital. They see opportunity because they're thinking in decades, not days. And that mindset, that long-term perspective, it's what allows them to compound wealth at rates that individual investors rarely achieve. Not because they're smarter, because they honor their time horizon. So here's how to avoid this final mistake. First, write down your actual time horizon. When do you need this money? Be specific. I'm investing for retirement in 25 years. I'm investing for my kids' college in 12 years. I'm building generational wealth that I won't touch for 40 years. Write it down, make it real. Second, create what I call time horizon buckets. Money you need in the next 1 to 3 years, keep it in cash or short-term bonds. Money you need in 3 to 10 years, balanced allocation. Money you don't need for 10 plus years, that can be aggressive, that can be 80%, 90% stocks. And when volatility hits, you only adjust the short-term buckets. The long-term buckets stay invested. You don't touch them. Because volatility today doesn't matter for money you're not using for 20 years. In fact, volatility today is good for those long-term buckets because you're buying cheaper. You're accumulating more shares at lower prices. That's how you build wealth. Third, automate your long-term investing. Set up automatic contributions. Every month, same amount, same day, into your long-term buckets, and never stop. Not during volatility, not during bear markets, not during recessions. Just keep buying. This is dollar cost averaging, and it removes emotion completely. The system just runs. Fourth, remind yourself regularly of your time horizon. I recommend actually calculating how many months or years you have until you need the money. If you're 40 and retiring at 65, you have 300 months. When markets are volatile, look at that number. 300 months. This month's volatility is 1 month out of 300. It's 0.3% of your timeline. And finally, study history. Look at long-term charts. The S&P 500 over 50 years, over 100 years. Yes, there are drops, scary ones. 1987, 2000, 2008, 2020. But zoom out, over every 10-year period, over every 20-year period, markets go up, always. If you honor your time horizon, if you stay invested, you win. That's how it works. That's how it's always worked. All right, let me bring this all together for you. 5 deadly mistakes that destroy wealth during volatile markets. Mistake number 1, trading too frequently. Jumping in and out, trying to time every move. The solution? Commit to minimum holding periods. Track your trading. Implement friction systems. Trade less, compound more. Mistake number 2, abandoning your strategic asset allocation during volatility. Going from 60-40 to 30-70 because you're scared. The solution? Set rebalancing bands. Document your allocation strategy. Only change allocations for life reasons, never for market reasons. Maintain discipline when everyone else is panicking. Mistake number 3, reaching for yield in the wrong places. Chasing 7% in junk bonds instead of accepting 3% in quality. The solution? Move up in credit quality during volatility. Focus on total return, not just income. Use core satellite approach. Remember that cash is okay. Preservation matters more than generation during stress. Mistake number 4, abandoning diversification and going all in on one narrative or theme. The solution? Maintain diversification always. Use position limits, maximum 25% in any single theme. Separate core from explore allocations. Test your narratives. Remember that multiple opportunities exist simultaneously. Diversification is your protection. And mistake number 5, the most fundamental, ignoring your time horizon. Reacting to short-term volatility when you're investing for decades. The solution? Write down your actual time horizon. Create time horizon buckets. Automate long-term investing. Calculate how many months you have. Study long-term history. Honor your timeline. These 5 mistakes, they're not theoretical. I've watched them destroy billions of dollars of wealth over my 50-year career. And I've watched the investors who avoid these mistakes, who maintain discipline, who think long-term, build extraordinary wealth. Not because they're brilliant, not because they predict the future, because they avoid mistakes. At BlackRock, managing over $11 trillion, we've built entire systems around avoiding these mistakes. Rebalancing algorithms, position limits, long-term performance metrics, systematic processes that override emotion. And you can do the same with your personal portfolio. You don't need $11 trillion. You need discipline. You need a plan. Now, I want to leave you with some perspective. Right now in 2025, markets are volatile. Uncertainty is elevated. People are anxious. I hear it in every conversation I have, and I understand why. Tariffs, trade tensions, recession fears, geopolitical uncertainty. There's a lot to worry about. But here's what I also know. We've been here before. Every single decade of my career has had multiple periods of severe volatility, and every single time the investors who made these 5 mistakes got destroyed, and every single time the investors who avoided them, who maintained discipline, who thought long-term, they built wealth. They didn't just survive, they thrived. Because volatility creates opportunity. When everyone's making mistakes, when fear is high, when panic is setting in, that's when wealth gets redistributed. From the emotional to the disciplined, from the short-term focus to the long-term thinkers, from the people making these 5 mistakes to the people avoiding them. Which side do you want to be on? So here's my challenge to you. Take these 5 mistakes, write them down, review your portfolio against them. Are you trading too much? Have you abandoned your allocation? Are you reaching for yield in the wrong places? Are you concentrated in one theme? Are you ignoring your time horizon? Be honest with yourself. And if you're making any of these mistakes, stop today, right now, build the systems to prevent them, create the rules, document your strategy, set your limits, automate what can be automated, and then stick to it through the volatility, through the fear, through the uncertainty. That's how you build wealth. That's how you win. After 50 years in this business, after navigating BlackRock through every kind of market environment, through crashes and crises and panics, I can tell you with absolute certainty, the investors who avoid these 5 mistakes outperform, not by a little, by a lot. Over decades, the difference is life-changing. Millions of dollars of difference. So don't let volatility destroy your wealth. Don't make these mistakes. Learn from the millions of investors who came before you. Learn from the data. Learn from history. And position yourself not just to survive volatility, but to benefit from it. Because the next 10 years are going to be volatile. That's guaranteed. The question is, will you be ready?